Jesse Livermore made his fortune not by chasing market euphoria, but by studying the precise choreography of financial collapse. While others saw chaos in market panics, he recognized predictable patterns rooted in the immutable laws of human psychology and crowd behavior. This paradox defined his legendary career and revealed a fundamental truth that most traders never grasp. Market despair follows systematic rules that create enormous opportunities for those disciplined enough to exploit them. His revelation began in the chalk-dusty bucket shops of Boston, where, as a teenage quotation board boy, he witnessed the raw mechanics of fear. Day after day, he watched intelligent traders transform into emotional reactors when panic struck. Fear didn't spread randomly through the trading rooms, it moved in geometric progressions, creating price dislocations that had nothing to do with underlying business values. Livermore noticed that rational analysis became worthless during these moments of extreme stress, while crowd psychology became supremely predictable. "There is nothing new in Wall Street," he would later observe, "because speculation is as old as the hills." The costumes changed trust companies in 1907, radio stocks in 1929, but human nature remained constant. Markets moved through measurable waves of emotion, from dangerous euphoria, through mounting fear, to complete capitulation. Unlike his contemporaries who focused on company fundamentals or insider tips, Livermore discovered that understanding these emotional cycles provided a more reliable edge than any other analytical approach. His systematic framework treated every sell-off as a three-act drama: pressure building beneath the surface, forced selling, breaking into the open, and finally despair exhausting itself when no sellers remained. The key was recognizing specific signals that revealed when panic was approaching, then positioning strategically, while others made emotional decisions. This psychological insight allowed him to convert market catastrophe into personal triumph through disciplined execution during the market's darkest hours. Livermore approached market collapse the way a structural engineer studies a bridge under stress, searching for hairline fractures that reveal themselves long before the entire framework gives way. Through relentless observation across multiple market cycles, he discovered that financial panic wasn't random chaos, but followed a precise three-phase architecture that repeated with mechanical reliability. This systematic understanding transformed him from an intuitive trader into a methodical student of crowd psychology under extreme financial pressure. The first phase, which he termed distribution, unfolded while public enthusiasm remained dangerously high. Smart money recognized structural weaknesses invisible to the crowd and began quietly liquidating positions into strength. Livermore learned to identify this stealth, selling through subtle tape action that contradicted surface appearances. Leadership stocks would hesitate on good news, rallying less than they should, while down days began carrying heavier volume than up days. The credit markets whispered warnings that few bothered to hear. Call money rates crept higher, brokers' loans expanded faster than earnings could justify, and the cost of maintaining speculative positions gradually shifted from comfortable to concerning. On the trading tape itself, he witnessed effort without corresponding result. Heavy buying campaigns that lifted prices modestly, followed by quick surrenders at the first sign of selling pressure. When these subtle cracks widened beyond containment, the market inevitably entered what Livermore called liquidation. Fear accelerated beyond the ability of optimism to contain it. Headlines finally caught up to what the tape had been whispering for weeks or months. Margin clerks, not company analysts, became the decisive actors, driving price movement. Rallies failed at levels that previously provided support. Bounces grew progressively shallower, and weakness spread from isolated sectors to encompass the entire market structure. Credit tightened systematically, forcing previously confident speculators to sell positions they had intended to hold. Livermore positioned himself to work with this accelerating current rather than against it, understanding that mechanical selling pressure created opportunities for those who maintained emotional discipline. The final phase, capitulation, represented maximum opportunity disguised as maximum danger. Panic crescendoed into complete exhaustion, as even the strongest financial hands surrendered their positions in despair. Prices plunged on sensational headlines, even as the underlying rate of decline began to decelerate. Volume spiked in final bursts of desperate selling, and increasingly dire news stopped producing new price lows. Livermore's counterintuitive insight was that the worst headlines often coincided with the best opportunities, because maximum pessimism indicated that sellers had finally exhausted themselves. He watched for the telltale inversion where maximum effort produced diminishing results, where the market's character shifted from eager liquidation to reluctant follow-through. This three-phase framework succeeded because it reflected the emotional logic of crowds under financial stress rather than rational business analysis. Credit strain provided the combustible fuel, distribution offered early warning signals, and liquidation delivered systematic opportunities for those disciplined enough to exploit others' psychological mistakes. By understanding that panic followed predictable psychological patterns rather than fundamental business logic, Livermore could position himself profitably, while others made decisions driven by fear and incomplete understanding of the cycle's inevitable progression. The panic of 1907 transformed Livermore's theoretical understanding into legendary profits through a masterful demonstration of systematic crisis trading. The year began with subtle warning signals that his trained eye recognized long before panic erupted into public view. Leadership stocks like Union Pacific showed telltale weakness despite favorable headlines, hesitating on good news and surrendering ground more readily than their fundamentals suggested. The San Francisco earthquake had drained gold and credit from New York, causing call money rates to creep steadily higher, making speculation increasingly expensive for leveraged traders. During the distribution phase, Livermore watched smart money quietly exit positions while public enthusiasm remained dangerously high. Trust companies had leveraged themselves beyond prudent limits, creating structural vulnerabilities that his systematic approach taught him to recognize. Volume patterns shifted ominously as declining days began carrying heavier trading activity than advancing days, revealing institutional liquidation beneath surface optimism. When the liquidation phase erupted with the Copper Corner collapse and trust company runs, Livermore acted decisively. He initiated short positions on decisive breaks below pivotal points, demanding confirmation through failed rallies before pyramiding additional positions. His risk management proved as crucial as his timing. Structural stops above failure pivots, careful position sizing for violent swings, and the discipline to add only when the market paid him for being right. The crisis reached crescendo when call money rates spiked to an astronomical 100% intraday, effectively freezing credit and forcing widespread liquidation. Banks hoarded cash, liquidity vanished, and even strong financial hands surrendered positions in despair. When J.P. Morgan's dramatic rescue efforts finally stabilized conditions, Livermore honored his fundamental rule to trade the sea tape rather than his opinions. He systematically covered his shorts and preserved enormous gains, proving that disciplined preparation combined with systematic execution could transform market catastrophe into personal triumph during one of America's most severe financial crises. The crash of 1929 represented Livermore's supreme masterpiece, a systematic campaign executed with surgical precision that transformed the greatest financial catastrophe in American history into an estimated $100 million vindication of his panic cycle framework. While the nation celebrated the Roaring Twenties speculative euphoria, Livermore recognized the classic distribution phase signals playing out on an unprecedented scale. He didn't announce prophecies or make dramatic predictions. Instead, he methodically ran a campaign built on structural observation and disciplined execution. His preparation began months before the October collapse, when brokers' loans reached astronomical levels and margin buying became a national obsession that infected even conservative investors. The leadership stocks betrayed the underlying weakness that surface optimism concealed. Radio Corporation of America, the era's most glamorous symbol of technological progress, began showing subtle fatigue, despite euphoric headlines proclaiming a new era of permanent prosperity. The stock hesitated on good news, rallies grew increasingly labored, and heavy volume leaked through on declining days, revealing institutional distribution beneath public accumulation. Through the summer of 1929, Livermore constructed massive short positions using his proven systematic methodology. He probed on weakness, taking initial positions when key technical levels surrendered, then demanded validation through failed rallies before adding size. Each pyramiding addition had to be financed by the market itself through existing profits, ensuring that conviction rode on evidence rather than ego or opinion. His approach remained incremental and methodical, building positions as the market's internal character deteriorated while surface appearances remained deceptively strong. The most challenging phase came during late summer when his contrarian stance seemed catastrophically wrong. The market continued grinding higher while he endured substantial paper losses and public ridicule from bulls intoxicated by seemingly effortless profits. His discipline during this period of apparent contradiction proved as crucial as his initial timing. He understood that great trades aren't made in moments of inspiration, but built systematically through extended periods when the position appears mistaken to outside observers. When September's initial break finally arrived, Livermore recognized his familiar three-phase framework, accelerating toward inevitable conclusion. The liquidation phase brought increasingly desperate attempts to support prices. But each rally grew progressively weaker as credit conditions tightened and mechanical selling pressure overwhelmed buying power. Black Thursday's ferocious rebound didn't shake his conviction because violent countertrend surges fit perfectly within his structural understanding of panic cycles. He protected positions with stops above failure pivots while adding to winning positions as rebounds rolled over at progressively lower levels. The October catastrophe delivered the capitulation phase with shocking violence as margin calls cascaded through the financial system. Black Monday and Black Tuesday created mechanical selling pressure that overwhelmed any pretense of rational price discovery. While panic gripped the nation and the ticker fell behind the frantic pace of trading, Livermore remained systematically detached, executing his predetermined plan with the same methodical precision that had guided his initial entries. His enormous profit wasn't the product of lucky timing or clairvoyant prediction, but the inevitable result of reading market structure and crowd psychology with scientific accuracy. He had traded the tape's internal character rather than the headlines that chased it, proving once again that systematic preparation, combined with unwavering discipline, could transform market catastrophe into personal triumph. Livermore's mastery of panic cycles rested on a profound psychological insight that separated him from every other trader of his era. Fear operated with mechanical consistency, while reason remained dangerously unpredictable. He recognized that financial markets were fundamentally psychological battlegrounds where intelligent investors transformed into emotional reactors when genuine capital threat emerged. This understanding provided his greatest competitive edge. But it would ultimately reveal the universal human vulnerability that not even legendary discipline could permanently overcome. His success stemmed from recognizing that panic created systematic inefficiencies through predictable behavioral patterns. When margin calls arrived, they created mechanical deadlines that forced liquidation regardless of business fundamentals or personal conviction. These deadlines produced one-way traffic that rational analysis couldn't contain or reverse. Livermore positioned himself to benefit from what he termed the smart money trap, where experienced traders became overconfident and attempted to catch falling prices too early in panic cycles. These premature buyers actually fueled additional selling pressure when their optimistic positions proved costly, creating self-reinforcing cycles of despair that systematic traders could exploit. The emotional sequence played out with theatrical predictability. Anticipation gave way to denial. Denial surrendered to fear. Fear accelerated into forced selling, and forced selling exhausted itself in capitulation. Livermore maintained clinical detachment while others succumbed to this progression, understanding that brokers and bankers, not investors, became the decisive actors during crisis periods because liquidity determined survival more than analysis. His systematic approach demanded that he trade the tape's behavior rather than his emotional reactions or prevailing sentiment, waiting patiently for market confirmation before committing capital. This psychological distance that enabled his crisis profits, however, eventually turned inward with devastating consequences. Success bred the same overconfidence that he had spent decades exploiting in others, creating a tragic paradox that his intellectual understanding couldn't prevent. After his legendary 1929 triumph, wealth and expectation raised the stakes beyond what his systematic discipline could bear. He began violating the position sizing rules that had protected him during his greatest campaigns, taking oversized bets that created personal financial pressure, incompatible with the detached observation that panic cycle mastery required. Most tellingly, Livermore started making emotionally driven decisions that directly contradicted the systematic approach that had created his fortune. He held losing positions longer than his rules allowed, added to failing trades without proper market confirmation, and allowed ego to override the mechanical discipline that had separated him from the crowd. The same human nature that created systematic opportunities during market panics proved inescapable even for those who understood its mechanics with scientific precision. His later bankruptcy revealed that understanding crowd psychology intellectually differed fundamentally from maintaining personal discipline when facing genuine financial stress, proving that mastery remained a continuous, fragile practice rather than a permanent achievement. Livermore's framework transcends its historical origins because it rests on the immutable foundation of human psychology rather than the ephemeral details of market technology. While algorithmic trading and global interconnection have accelerated the speed of modern markets, the fundamental emotional patterns that created his systematic opportunities operate with the same mechanical reliability that characterized the bucket shops of his youth. The challenge lies not in abandoning his insights, but in translating them into the language of contemporary market structure without losing their essential wisdom. Today's distribution phase reveals itself through the same dangerous euphoria that preceded every major crash, though the symptoms now manifest across a broader spectrum of modern instruments. Excessive leverage appears not only in traditional margin debt but in the casual normalization of options speculation, where weekly zero-day bets become routine entertainment rather than calculated risk. Leadership stocks betray underlying weakness through relative strength, erosion, and breadth deterioration that contradicts surface optimism, while credit conditions tighten at the edges through widening corporate spreads and flattening volatility term structures. The surface remains deceptively strong while the market's internal plumbing whispers warnings that few bother to decode. The liquidation phase announces itself when effort stops producing proportional results, just as Livermore observed a century ago. Price breaks through key technical levels on expanding volume, while rallies die at former support zones, revealing that institutional distribution has overwhelmed retail accumulation. Exchange-traded funds now transmit selling pressure mechanically across global markets, creating forced unwinds that operate independently of fundamental analysis or investor sentiment. The weakness migrates systematically from speculative story stocks to established bellwethers, then spreads across asset classes as high-yield bonds, small-cap equities, and cyclical sectors confirm the underlying stress through synchronized decline. Capitulation remains the most psychologically challenging phase to navigate, yet it offers the greatest systematic opportunities for those who understand its character. News flow turns apocalyptic, while volume surges into desperate late-day liquidation, yet prices begin refusing to make fresh lows, despite increasingly dire headlines. The VIX spikes to historic extremes, while options positioning reveals maximum pessimism. But these sentiment extremes often coincide with selling exhaustion rather than continued decline. Credit spreads blow out to crisis levels even as funding strains begin easing at the margins, creating the classic divergence between maximum effort and diminishing result that Livermore hunted throughout his career. Applying this framework systematically requires adapting his disciplined approach to modern market realities while preserving its psychological core. Position sizing must account for contemporary volatility regimes, where algorithmic gaps can breach traditional stop levels, demanding structural protection rather than mechanical exits. Risk management techniques must accommodate systematic selling programs that can overwhelm individual conviction, requiring traders to work with mechanical currents rather than against them. The psychological disciplines remain unchanged: independent thinking that resists consensus opinion, emotional control that maintains objectivity during extreme stress, and patience to wait for confirmed setups rather than forcing trades during unfavorable conditions. Modern analytical tools enhance rather than replace Livermore's systematic observation. Volatility terms, structure analysis, credit spread monitoring, and sentiment measurement provide enhanced precision for identifying phase transitions, yet these instruments merely supplement the core skill of reading market character through price and volume behavior. The essential insight remains that panic cycles create systematic inefficiencies through predictable human responses to financial stress, rewarding those who combine methodical preparation with disciplined execution, while others make decisions driven by fear and incomplete understanding of the cycle's inevitable progression. Markets evolve continuously through technological innovation and regulatory change, but the human psychology that drives panic selling operates according to timeless patterns that systematic traders can exploit through patient observation and unwavering discipline.